Now let us look at the short run disequilibrium and how it comes back to the equilibrium position. There are two cases. First is when we are running below full employment level, below the long run average aggregate supply curve, and the second case is above, when we are producing more than the potential real GDP. So let us look at the first case. Here, suppose at first this was the supply curve, aggregate supply in short run, and this is the aggregate demand curve, and they were cutting at this level. This was the price P1 and GDP was say Y. This was the real GDP. Now what happens? This curve shifts rightwards. There could be multiple reasons. We have already seen them. For example, the labor productivity has increased or the input prices have come down. The raw material have become cheaper. So the curve shifts like this, rightwards. And now it is going to cut the same demand curve at this point. At the new point, we have the new price P2 and income shifts to Y2. Suppose it was Y1 earlier, now it shifts to Y2. Now what happens at this level? The prices are down. So we have achieved Y2, which is our potential real GDP. So when we are operating at some other level where our GDP was less than the potential real GDP or less than our long run aggregate supply, in that case there will be a push. It could be, for example, because of the downward wage force, because at that level the prices will be higher. So this downward wage force will push the supply curve downwards so that we'll achieve potential real GDP. Similarly, if we are above full employment level, suppose we are here, the price is this P2, right? This is our aggregate demand curve. Demand remains same. We are at this level, Y2. So automatically there will be an upward wage force, and the price levels are low here and we are producing more than the GDP. There will be upward wage force that will push the input prices of the companies up, and there will be a leftward shift in the supply curve, short run supply curve. Automatically we will cut the demand curve at this level where we are equal to the long run aggregate supply curve or potential real GDP. At that level the prices are higher, the wage levels will be higher, so we will be exactly at the potential real GDP. So there are market forces which will push it rightwards when we are below and leftwards when we are above the potential real GDP. So that is the restoring of the equilibrium point from left and right both sides. Now let us look at the changes on the aggregate demand curve and what happens. Suppose there is an increase in the demand. So aggregate demand curve shifts rightwards. What happens? Earlier it was AD1 and it was cutting the short run aggregate supply curve at P1. So this was the price. This is the quantity produced, GDP1, at this point. But now there is an increase in the aggregate demand curve. It shifts to AD1 to AD2. Now this is the new point on the same supply curve we are talking. So this is new price and new GDP. So we are obviously producing more quantity and a higher price. Now this price increase will also contribute to the increase in the input prices for the companies, which will put a pressure on the supply curve to shift leftwards. And because of this pressure, the supply curve shifts leftwards. This is our new supply curve. This is our new demand curve. They are going to cut at this point. Now long run, this is the price PLR and this is your GDP. So effectively we are getting back to the same GDP level at a higher price. So corresponding to a rightward shift in demand curve, there was a leftward shift in the supply curve so that the quantity produced, the real GDP remains the same, but the price level goes up. Now let us see what happens when there is a decrease in the demand curve. The shift in the aggregate demand curve is leftwards. For example, earlier we were here at this level, GDP 1. This is GDP 2. Suppose we were at this GDP 1 level and price was P naught. This is our demand curve. This is our supply curve in short run. The demand curve shift leftwards. Demand comes down. So this curve becomes the new curve. Supply curve remains the same for a while. So we get the new point where our GDP is GDP2, which is reduced, which is less, and the price is also less. So we are producing less quantity at a lesser price. New supply curve. Because of the lower prices, the input prices to the companies will also come down and they will put a rightward pressure on the supply curve. So because of the lower prices, the supply curve shift rightwards. The companies are able to produce more now. So now we have new supply curve. This is our new demand curve. They are going to cut at this point, and in the long run this is going to be our price and this is going to be our GDP. So we have really achieved the GDP back and at a lower price in the long run. So this is the impact due to decrease in the aggregate demand. So there are shifting leftwards and rightwards so that a new equilibrium at the same level of GDP is achieved. Now let us move to the next concept, the concept of stagflation. What is stagflation? This is a peculiar situation in economics where the inflation rates are high and the GDP growth is low. So we are not able to grow even though the price levels are higher. As the government can not address a difficult situation, the government can either control inflation and reduce the rates, or it can increase the money supply to increase GDP. So for inflation control, the interest rates have to be higher. For increasing GDP, the interest rates have to be lower. So there is a conflicting interest. So it is a problem for the government. How does it happen? When the suddenly supply decreases, this short run supply curves shift leftwards. Suppose this curve has shifted leftwards. Earlier what was happening? This was the supply, this is the demand. We were producing GDP 1 at the price P1. This was our point earlier. Suddenly the supply curve shifts leftward, supply decreases. So we have new supply curve SRAS2. So we are on the same demand curve. Now the price is higher and the GDP is lower. We have moved from price P1 to P2 and GDP1 to GDP2. Now we are producing less and at a higher price. As a reaction to that, we are in a typical situation where even at a higher price we are producing less. So P2 is higher than P1. That says this is a case of inflation and our GDP2 is less than GDP1. That says this is the case of low GDP growth or recession. So in recession, inflation is happening. That is the case of stagflation. So what is the solution? The government has to push this demand curve up. This is the solution. The government has to shift the demand curve up so that we will be able to achieve the same GDP level. How that would be done? The government has to increase its own expenditure. It has to make the money supply available. And there are supply side constraints which should be addressed. So a combination of these approaches have to be applied so that we can gain back the same GDP level and the problem of stagflation is addressed. Let us move to the next concept, the sources of economic growth. As we know that the demand can be increased in short term, but for economic growth there has to be increase in the supply. So the long run aggregate supply curve which represents the potential real GDP, that should be shifted rightwards. That will indicate the economic growth. So our factors are going to be the same. If the labor supply is increased, if the availability of natural resources is increased, if the stock of physical capital is higher, if the labor productivity is high, or the quality of labor, the skill set of the labor has gone up, that is increased human capital, or there are advances in the technology. So any of these reasons will shift the long run aggregate supply curve rightwards or increase the potential real GDP, or in other words, they would be sources of economic growth. Let us look at the next slide, the sustainable growth. So what would be the sustainable growth? When the potential GDP, which is a product of aggregate hours the laborers are putting in into their productivity. So that would give you potential GDP. So for sustainable growth, these should increase. Growth in potential GDP will be growth in the labor force and growth in labor productivity. For growth, either more number of hours should be put in or the productivity has to go up. So long-term equity returns are dependent on the sustainable growth. If the economy is growing at a sustainable level, the potential GDP is rising, that would indicate the long-term gains on the equity, the stocks in the economy. Now let us look at one other important concept, the production function approach. Here we are looking at the GDP or the income of an economy with respect to the production function. So what are the component here? Y is the aggregate economic output or GDP. L is the size of labor force. K is the amount of capital available, and A is the total factor productivity. So that could increase in output not from the labor and capital but from other factors which could be related to advances in technology, etc. So there are two important factors, the labor and capital, which are contributing to the economic output. So economic output is a function of labor capital, and there is one more factor which is total factor productivity, which can be increased through some advance in technology, etc. There could be one more variant of the same approach where we are looking at output per worker. Instead of output, we are looking at output per labor force. So it becomes A, which is total factor productivity, into function of K by L, that is per unit labor, what is the capital available. So this can be used because we know that the productivity of capital comes down. It is showing the diminishing marginal utility. So that is why in developed countries, the progress will more rely on technology. So this factor has to be increased for a growth in economic output rather than relying on labor. So effectively, what are the components of economic growth? Growth in potential GDP would be growth in technology. That was the factor A which we looked at. Then WC into growth in the capital and WL into growth in labor. So WC is the weight of the capital in the economy and WL is the weight of labor in the national income. So this will give you the growth in potential GDP. Or if you want to calculate per capita, then we have to look at growth in technology plus WC, growth in capital to labor ratio. So that will give us the growth in per capita GDP. As we know, in developed countries, the ratio of capital is higher as compared to the labor, and the growth in the GDP come from technological advantage, the A factor. Let us take a numerical example to understand it better. Say growth of potential GDP has been noticed to be 7%. The labor share of national income is 70%. So for capital, the share becomes 30%. The increase in the labor force has been 6% and increase in the capital stock has been 5%. So we are asked what is the increase in technology over the period. So we know the potential GDP growth 7%, which is already given, is equal to the increase in technology, that component, plus the increase in labor force, that is 6%, into the weight. What is the weight of labor? 70%, that is 0.7, plus The increase in capital stock 5% and the weight of the capital in the economy, that is 30% or 0.3. So we can solve it as 7% is equal to x plus 4.2% plus 1.5%. So x comes out to be 1.3%. So that is how we can find out any of the variables which is not available. Let us take a few more questions here.